Most investors believe diversification simply means owning many different assets. Stocks, bonds, real estate, maybe some gold. On the surface, that sounds reasonable, but here's the problem. Just owning more assets does not automatically reduce risk, because if all of those assets respond to the same conditions, they will still move together. And when they move together, they fall together. So the question is not how many investments you own. The real question is, how do they behave when the market changes? Because that is where diversification actually begins. Here's what most people don't realize. Financial markets are deeply connected. Assets don't exist in isolation. They are influenced by the same underlying forces: interest rates, inflation, economic growth, global sentiment. So when something shifts, it rarely affects just one asset. It affects many at the same time. That's why during a crisis, stocks fall, real estate weakens, even entire sectors collapse together, and suddenly, what looked diversified was never truly diversified at all. This is where real diversification comes in. It's not about owning more. It's about owning differently. Assets that react in different ways, assets that respond to different environments, because when one struggles, another may hold or even rise. That difference in behavior is what creates balance. And balance is what protects your portfolio. Without that difference, you don't have diversification. You just have multiple versions of the same risk. Think about it this way. If all your investments go down at the same time, you are not diversified. You are concentrated, even if you own 10 different things, even if they look different on the surface. Because underneath, they are driven by the same forces, and that means they share the same risk. This is one of the biggest illusions in investing. It feels safe, it looks diversified, but in reality, it's a single bet spread across multiple assets. Real diversification works differently. It spreads risk across assets that do not behave the same way. This concept is called correlation. Some assets move together, others move independently, and some even move in opposite directions. The goal is not randomness, the goal is structure. To combine assets in a way where weakness in one area is balanced by strength in another. That's how you reduce overall volatility. Not by adding more, but by adding smarter. For example, stocks may perform well during economic growth, but during uncertainty, they can fall sharply. At the same time, bonds may become more stable, gold may act as a hedge, and other assets may respond in entirely different ways. Each asset reacts to the world differently, and that difference is valuable because it creates resilience, a portfolio that can adapt instead of collapse. And that is the foundation of true diversification. This is how professional investors think. They don't focus on individual investments first. They focus on how everything works together, because a portfolio is not a collection of assets. It's a system where each part has a role. Each asset contributes something different: growth, stability, protection. And when those roles are combined correctly, the portfolio becomes stronger than any single investment inside it. That's the shift. From picking assets to designing systems. Because randomness does not create stability. Structure does. A well-built portfolio is intentional. Nothing is there by accident. Each asset is chosen for a reason. Each position serves a purpose. And more importantly, each one interacts differently with the others. That interaction is what matters. Not the asset itself, but how it behaves inside the system. That's what most people miss. They look at investments individually. Professionals look at relationships. And this is where diversification changes everything, because it doesn't eliminate risk. That's impossible. Risk is always present. But what diversification does is reshape how that risk behaves. Instead of one big exposure, you create multiple smaller ones. Instead of sharp losses, you create controlled movement. Instead of chaos, you create balance. And that difference is what allows portfolios to survive over time. Without diversification, outcomes become extreme. One wrong move, one market shift, and everything can drop at once. But with proper structure, those extremes are reduced. Losses become more manageable. Volatility becomes smoother. And the overall experience changes. Because investing is not just about returns, it's about staying in the game long enough for those returns to actually compound. And here's one of the most important ideas: diversification is not about avoiding risk. It's about controlling it, understanding it, designing around it. Because once you accept that risk is always there, you stop trying to eliminate it. And instead, you start shaping it. And that's a completely different mindset. One that gives you control instead of fear. Because risk is not the enemy. Uncontrolled risk is. And diversification is the tool that gives you control. It allows you to decide where your exposure comes from, how much impact each asset has, and how your portfolio reacts under pressure. That's what makes it powerful. Not the number of assets, but the structure behind them. That structure determines everything. This is what separates amateurs from professionals. Amateurs chase returns. They look for the next winning investment, the next opportunity, the next big move. But professionals think differently. They don't chase outcomes. They build frameworks, systems that can perform across different conditions. Because consistency beats luck every single time. And once you truly understand diversification, your thinking changes. You stop asking, "What should I buy?" and start asking, "How should this fit into my portfolio?" Because the value of an asset depends on its role, not just its return. And that shift is where real investing begins, not in selection, but in structure. Because in the end, the structure of your portfolio matters more than any single investment inside it. You can have great assets, but a weak structure, and that leads to unstable results. Or you can have a strong structure that makes even average assets perform better together. That's the power of diversification. It's not about perfection, it's about balance. And in the next episode, we'll break down one of the most underestimated forces in investing: time. Not just how long you invest, but how time changes risk, how it changes outcomes, and why the same investment can be safe or dangerous, depending only on your time horizon. Because once you understand time, you stop thinking short term and start building real long-term wealth. That's what we'll explore next.